Welcome to Real Smart, the real estate podcast you've been waiting for. I'm Spencer Kallick, a real estate and land use attorney at Allen Matkins. On this show, I sit down with some of the most dynamic and accomplished voices in real estate to explore trends shaping the industry and uncover what truly sets great leaders apart. Hey everyone, thanks for joining us today on the podcast. I have a great guest with me today, Zach Streit from Priority Capital Advisory. I think I got it right.
Got it right.
And just super excited to have you here. Obviously, we're friends. I've known you for a long time, but would love for everyone out there to know about what you do, what you're up to. So, because I know you've been very entrepreneurial recently, starting your own business in this space, although you're not new to it. So tell me a bit about Priority Capital Advisory and who you are, what you're up to, what's going on, why are you sitting here today?
Wonderful. Well, great. First, thanks, Spencer. It's an honor to be here. I can't believe that I made the cut, so it's good to be here.
It's a tough lift, but yeah, we got.
I've seen you had before, so it's really an honor. But I'm Zach Streit. I am the founder and president of Priority Capital. Priority Capital is a middle market debt and equity finance brokerage shop. We help entrepreneurial sponsors and some institutional ones get financing for their projects. It's mostly debt financing with a sprinkle of equity in there too to kind of keep things spicy and interesting. And we tend to focus on deals that have a total capitalization of $25 million and up. And say the sweet spot for us is deals maybe in the $25 to $75 million range. And we're working on one that's a $250 million deal. So we have the ability to flex up. We're usually not working with first timers. They're typically guys who are seasoned. They've come out of family offices. They've come out of institutions. It's not their first rodeo, but they're looking to scale their platform, and we're there to help them on the capital side.
And this is not your first rodeo. You've been in this business for a long time. Maybe tell folks kind of how you got into this and your journey to starting Priority not too long ago.
Yeah, no, I appreciate that. Well, it hasn't been linear to say the least, but I've been in the commercial real estate industry now for 20 years, which is incredible to say. It's been a long time. I spent the first 10 years of my career on the principal side, about 4 years as an equity investor at a big UK life company called Aviva, which sold its US business to Apollo and LaSalle. And then I spent about 6 years as a lender, including doing a couple years at Colony Capital. And then for the last 8 years or so, or almost 9 years now, I've been a debt and equity capital advisor. So I certainly didn't come out of school and just start my shop. I had a lot of sort of track record and experience behind me. But I've always been an entrepreneur and I've always wanted to have something that is my own. And it's amazing to finally be here and to have that. We've had a hell of a run. In our first 11 months in business.
It's only been 11 months?
It's only been 11 months since I started it, which is crazy. So the middle of May will be our 1 year, anniversary.
We're doing to celebrate, by the way. You got big plans or something?
You and I'll go golfing. I heard about that. That's good celebration.
Exactly. No rest for the week.
No, we're always doing something else, but plenty of client events and fun and stuff like that. But in 1 year or almost 1 year, we've closed 15 transactions. We've arranged a total of $325 million on deals that probably have a total capitalization in excess of $500 million. And I'm really proud of that. We did that leaving one platform and starting another, having to assemble a new team, and having to source business in a market that's tricky, that has its opportunities and has a decent amount of capital availability, which we'll talk about, but it's by no means an easy market. Underwriting standards are still sort of strict and high, and lender scrutiny is there. You probably see it, in the borrowers that you represent and the lenders that you represent. It is very, very difficult to get to yes. And despite that, we still managed to do it. We are doing it. We're probably exclusive on another, 12 or 13 deals, including some that are pretty big. And so I'm excited about the second half of the year and what it might bring.
So talk about this, right? Most people will tell you this is the most challenging economic time they've certainly seen in a long time, but you're still finding ways to get deals done. I'd love for you to tell us the secret sauce, but what are you seeing besides just being a hustler like I know you are, that is helping to get deals over the finish line in this super challenging real estate and economic environment?
Great question. Of the last 12 months, I think maybe 2 are optimistic. I think December and January were optimistic. We had an election behind us. We had 4 rate cuts. As is normal at year end, people get very optimistic about the year ahead. Before that, you had high rates and you had kind of presidential election volatility. And kind of starting in February, you've had people talk about tariffs. And then tariffs actually happened, or they are happening.
Yeah.
And
check out watch. I don't know. By the time we live, will we have tariffs? I have tariffs. I don't know.
The iPhone going to cost $10,000? Like nobody really knows. So that's been hard. So the challenges are out there and the challenges are real. Look, I don't have a secret sauce. I've always been a hustler. I've always been a bit of a killer. I work really, really hard. And through working hard, I positioned myself to be able to get lucky. And that's really it. And it doesn't matter if it's an up market or a down market or a sideways market, that instinct to really kill for my clients, to do everything I can to shake every tree, to look under every rock has really gotten me, over the course of my career to, I don't know, $3-4 billion in arranged financings to the 325 that we did to start. That's really what we're doing. There are positive forces out there also. I'm sure that you see them. The biggest positive force that I can see in the real estate debt capital markets over, let's say, the last 6 months, so predating tariffs, and even predating the election, was the reemergence and I think the resurgence of regional banks. Regional banks, and to some degree money center banks, are lending today and injecting liquidity into the market today in a way they haven't in probably 3 or 4 years now, since the interest rate run up started in 22. We just closed an $11 million retail development loan, right? In the post-tariff era, we closed a development loan.
Amazing.
2 Fridays ago. We did it with a bank. We did it at 65% loan to cost, and we did it at a spread of 270 over. Now, this retail development deal had no anchors, so it was strip experiential retail. It had no credit, and it was in a somewhat enterprising location as well.
And you found a way to get it done.
We found a way to get it done, and at an incredibly accretive spread. When you talk about a spread of 270 over, you're talking about 7% financing in what is a SOFR environment of 425. Yeah. That's really, really cheap. And we did that with a bank. 6 months ago, sure, it was UMB Bank. They're a wonderful bank. They're based down in Arizona. They're kind of a regional bank. We actually apped a second deal with them for that same sponsor. So appreciate their service and how much they helped. 6 months ago, if you got that bid, it was with a massive amount of deposits. Recourse. It was recourse. It was probably lower leverage. There was still recourse on this bid, sure, but it burned down. If we would have had higher pre-leasing, we had pretty low pre-leasing. We may have started with less than full recourse. And 18 months ago, you don't even get the bid at all. So that's how much has changed in a short period of time. I think the reason that's really important is for sponsors that are a little bit more institutional, working with deep-pocketed equity capital sources, whether they're institutions or family offices or insurance companies. The lack of availability of bank debt made it almost impossible to build. Like if you could get past low return on costs, and if you could get past labor shortages and whatever other issues were out there, you still had this bogey of, shoot, like I can only get 50% bank financing. That doesn't make sense. And then I've got to go to a debt fund at 70%, but with a debt fund, I'm going to pay 450 to 500 over. I don't borrow at a 10% rate. But all of a sudden, the world of 7%, 7.5% financing is back. And at least from a cost of debt capital perspective alone, that's pretty accretive. That's pretty interesting to guys that have been on the sideline for a long time. That doesn't mean the floodgates just unleashed. We've got other challenges, but this was a big missing piece.
It requires a bit of ingenuity. I think one of the things I know about you is you are a hustler, and sometimes people think of that in the pejorative, but I mean it in the nicest way possible. You've got to be out there. You've got to be in front of people. You've got to be talking to people. You've got to not just have relationships, but develop those relationships in a way that they know when you pick up the phone or you send an email, hey, this is something that we should look at. The other thing I think a lot about is our clients, the banks, folks you're working with every day, they don't get paid unless they're doing deals. So while there is certainly some folks who is close-up shop or a little tighter on things, a lot of folks have to do these deals because it's their livelihood. And frankly, there's a lot of dry powder, as you know, that's out there. And it's just a matter of how do you structure things? How do you set it up in a way with folks that they feel comfortable lending that money? It's a big part of the work that I know you do every day.
I appreciate that. And I think you're touching on something that's really interesting. And I know you don't mean it pejoratively. And by the way, when I said I'm a killer for my clients,
you are a killer. I know that.
Not literally, metaphorically.
When I go out, like, it doesn't matter where I am, whether I'm in LA, whether I'm in New York, I'm in Chicago, and people are like, oh, do you know Zach? I'm like, yeah, of course I know Zach. How did you know Zach? Where have you been hanging with Zach? It's like, literally, I can't go anywhere. I can't walk in the street without someone being like, oh, I just had coffee. I just had lunch with Zach.
Thank you.
That's part of who you are and part of what makes you very, very good at your job.
Thank you. No, I really appreciate that. And look, brokerage is technical sales, but it's still sales. And so it requires being in front of people always, and it requires connecting the dots always, and it requires being creative always. One interesting thing, and maybe this speaks to creativity a little bit, I think many borrowers today, sponsors, might not be fully aware that despite tariffs and despite still stubbornly high, both long-term and short-term rates, your point is a good one. It's a borrower's market out there. From the perspective of there is more capital than there has been for 4 years. There's cheap capital that's available today. And there are a lot of lenders, both banks and non-banks, that are starved for revenue. They need to generate origination fees. They need to generate interest income. And they can't go on indefinitely, and they already have for 4 years, not being income producing. So as much as bank balance sheets appear to be healthier, there are deposit inflows that we're hearing about. And I guess people are, the 10-year treasury, they bought it at 5, sold it at 4, and then that money went back into banks modded loans. You certainly cannot ignore, or one cannot ignore what you're saying. It's a fiercely competitive debt fund market. It is crowded. Hire a broker. Use somebody to help you navigate.
You know any good brokers, by the way?
I know a couple. Yeah, not many.
I think you're right.
And they can help.
I think you're right. I see in this environment right now, people are trying to do more with less, and they're saying, hey, like, I don't need an attorney. I don't need a broker. And by the way, for some people, sure, fine. They know what they're doing. But a lot of folks, they don't. And it's not meant in a negative way.
Yeah.
It's like, I wouldn't go fix my heart by myself. No, I would go hire a heart surgeon, right? You need to hire someone who knows actually what they're doing and how to do it.
And it's so complex today. Like, most people don't think to ask, hey, debt fund, do you back leverage? And if you do, well, who's your back leverage? Yeah. Are they money good? Like, how many back leverage lenders are you going to?
It's not your normal banking relationships, right? Some people used to do stuff with City National Bank on every single deal. God bless them. I bank with City National Bank too. But they're not lending as much on these kind of deals anymore. And it's folks that, you haven't heard about a fund, all these names. I always joke, like in real estate, every name sounds the same. You just don't know, right? So having someone who's not just done one deal, but multiple deals with these folks makes a big difference.
I couldn't agree with you more. And I'll make the same plug on the legal side. Use somebody that knows what they're doing.
Exactly.
Do you know anybody good there?
There's got to get some attorneys here.
I have seen attorneys that are awesome, like you, shepherd amazing deals to closing. And I've seen some delay, stall, cause incredible angst, discord. And so, it's the same thing.
It's a thing. It's a thing. So talk to me about asset class, right?
Sure.
Like, as you walked in here, we were talking right behind us, the JM building, which is, I think, the only new office building going up. Certainly California, I don't know, maybe even writ large.
Everywhere outside New York and Miami? Probably.
So tell me what asset classes are seeing the most activity, the most velocity in terms of deals across your desk right now, why that is, and frankly, what is kind of the difference maker for those kinds of deals right now?
Sure. It's a great question. And I think the answer may throw you for a loop. I have just closed one ground up retail development deal that I mentioned earlier on the pod, and I'm working on 5 other retail deals. I haven't worked on 6 retail deals, combination of ground up and existing stuff, maybe ever in my career at one time, and certainly not in the last.
Is that because you're proven sponsors? Is it because of the location? What's
driving retail?
Yeah.
Retail, similar to banks, is having a resurgence, and it's having a resurgence because inflation helps with percentage rents. Consumers are still spending, and in certain locations with respect to development, you've had massive population migration to certain markets and certain areas within the market, and you haven't had retail development in at least a decade. Mm-hmm. So when you have a surplus of people who have a certain per capita income, flood a location, and you have no retail development, those two twin forces peak developer interest and they cause projects to start happening.
Interesting.
So we're working on 4 ground up deals in Phoenix, all that are not Scottsdale, and they're not main locations. They're sort of like
standalone retail. Those are not mixed-use deals. These are just pure.
This is pure retail. 3 of them are kind of experiential strip deals, no anchors and limited to no credit. And one of them is shadow anchored by like 2 large, let's say, credit tenants, a grocer and a home goods store. But the anchor and credit collateral isn't part of the package. It's shadow anchored. So it's all inline soft good.
And those deals are getting done right now.
We closed 1. We have signed term sheets on 2. I was a little late to your office today because on the 4th deal, we were at a long call with a lender, and knock on wood, it's a $47 million loan. It gets signed before the end of the week. And that's just the ground up stuff. We're doing 2 other retail deals here, one in the Golden Triangle, trophy stuff. The lender basis is thousands of dollars per square foot, the lender basis. Incredible rents. And then we're doing another one in NorCal. That's a retail deal as well. Both of those will finance probably around 6%. The NorCal one a little wide because the credit's not quite there. And the one in the Golden Triangle probably will finance sub 6%. So you have retail that will get done in the same vein and in a similar sort of pricing profile to multi. That's amazing. That's not something that we've said in a while too. There's always been some spread because, my gosh, you've got a big box and it rolls. How do you fill it? You've got the Amazon problem. I would say that retail is having its day in the sun right now. And it's not really a function of us having done any retail specific targeted marketing, which maybe we should, and I'll go to ICSC, that'll be part of it.
Sure.
But it's mostly just sponsors that I've covered for a long time, many of whom are repeat clients for me. In fact, almost all these guys are repeat clients who have sort of either had retail in their portfolio and realize it isn't a bad time to pull the trigger on a refi, or saw the supply-demand imbalance, said, hey, we need to build. And maybe I'm not building in Maine because that's pretty saturated and how do you access the land? But I'll build where people have gone. And it's a pretty smart thing. The reception in the debt capital markets has been pretty amazing.
Okay, so retail's amazing. What about multi? Everyone wants to build multi right now. Is there any money out there to build multi? I mean, it feels like a lot of the projects I'm working on right now, we're entitling a lot of units, but it's really tough getting them out of ground.
It's funny how things change. Multi was the belle of the ball for so many years, probably from 2010, 2011 through 2022 with a little 6-month blip during COVID that, doesn't count. It was probably the most liquid asset class. It's still incredibly liquid with respect to Fannie and Freddie and agency on the takeout and HUD as well. But from an equity perspective on development deals for multifamily, there simply isn't a functioning market. It is frozen solid, and it's been that way for probably 3 years now.
Are you talking about multi or talking about office? Because right now it sounds like you're
talking about right? Well, I'll talk about office in a minute. We're working on a few ground up multi deals, but all those have the equity spoken for. They aren't new raises. And I've taken out a few deals on the equity side to just continuously tap the market for good clients of mine. And even for the highest name, super notable, owns tens of thousands of units type sponsor to kind of a newer guy starting a shop, there just doesn't seem like there's equity available for multi-development. I'm seeing some cracks with respect to value add. We're actually pretty close to brokering an equity relationship for a value add multi-purchase in Dallas. It's a $10 million purchase. We went out to 50 equity capital sources and we got 49 no's, but we got one pretty strong yes. So that's positive. That comes on the heel of another process that we were close on, but ultimately didn't bite. It was a tough submarket in the Midwest. So I'm seeing some, call it green shoots on the value add side. But when it comes to development for multifamily, it's really tough. I think you need a 10-year, like at 4% for 3 months for people to dip their toes back in the water. That seems like a pretty high bar.
It's hard to get.
So right now. I'm not holding my breath for it. Or if you're SoCal or your other jurisdictions that have affordable regulation, one bright spot within multi is ED1. We closed an ED1 loan, a $19 million loan.
No, ED1 is in the city of Los Angeles, the executive directive one, which is the mayor so basically saying, hey, we're going to fast track housing if you meet certain criteria. But that's really niche to LA and only certain locations. That's not writ large of all the other development that's been happening across the country.
My takeaway is, ED1 allows for property taxes to be abated, somewhat similar to like what a PFC can do in Texas, but that's different. It's under some fire. You need some sort of affordable angle for multifamily to pencil today, and you need some sort of tax abatement for it to pencil today, and to really get like an equity capital source interested. Short of that, anything market rate is I think, unfortunately going to be very hard. So, we pivoted. We're doing some multi-bridge deals, and we're doing some deals where the equity is spoken for. And look, there's debt capital available for it. It's not a shortage of debt.
It's just expensive. It's complicated.
But the lack of equity seems to be a much higher, much bigger barrier.
Okay, so we talked about multi. We've talked about retail. Office looms literally over our shoulders, and everyone wishes that they own office in Century City. But let's say you don't. Let's say you own in downtown LA or a B or C market at the moment. Is there any money out there?
Yeah, good question. So I've closed 3 office loans in the last year. One of them was the best deal that I did all of last year, I think. A sponsor was buying an office.
Because it's closed and you got paid, or what?
I like the way you think. In part. Okay. The truth is it was an asset in Costa Mesa, jewel box, 100% leased, all post-COVID leases, anchored by an urgent care that had been there for 30 years, doing fantastically well. The seller was a large fund. This was the last asset in their fund. They unfortunately lost a lot of money on it. The buyer got an excellent basis. He bought almost a 10 cap, and we financed it at 7% fixed with a bank. You had almost 300 basis points of positive leverage on an office transaction. You can't find 300 basis points today in any other asset class of positive leverage. It doesn't exist.
Yeah.
And you can find it in some cases and with a lot of work in office. Sponsors, I think, are going to do phenomenally well on that deal. So there is capital available. It does usually require a reset basis, or it requires a story. 2 other deals I did were both bridge-to-bridge deals. They had a maturing loan with a debt fund who couldn't extend. One financed in the double digits. It was very expensive money. The other financed at around 8.5%, which really, really wasn't bad. It was an office deal in Austin. Had a good heavy retail component that helped, but I think it was still at least 50 or 55% office. And there was roll. There was limited wealth. There was roll. So for good sponsors with a story, with a plan, with the right leasing broker in place, and in the right locations, you can finance office. Commodity space is very, very tough. For commodity space, either it's an acquisition at a reset basis, or if you're trying a bridge-to-bridge refi, you have to be thinking cash in. It doesn't have to be huge, but it has to be something that if it recommits, to have a lender say, hey, I'm not going to take a half-empty building back. Now, it also depends, where and who. Like financing stuff in downtown LA could be really, really tough. Downtown SF, that's probably really tough too. But the second you're not in an urban core that was really blighted by COVID, I think there are possibilities out there, and it's worth pursuing, and it's worth trying.
So let's digress a little bit to what I would find more interesting as well, which is, you're running a business every day. A lot of people, don't realize that there's a lot of work that goes into every day in hiring folks and setting things up, and really being a leader, not just with your own folks who work for you, but also just writ large in the community and what you're doing every day. So maybe talk to me a little bit about your leadership style. And it's cheesy, right? Like, oh, I'm a leader, but like, how do you approach not just the people, your clients, but also your employees and your team every day?
Yeah, that's a good question. It's not an easy one. Look, I like helping people. I'm pretty, like diligent and focused when I do, but hustling for my clients is really just a form of helping people. So I think I also like helping my staff. Now, look, they're there to support me and they need to do certain things, but ultimately I'm trying to help them grow and I'm trying to help them make money. So I take a pretty constructive approach, I think, to leadership. And I want to let them know that like I have their backs, that I really do care about them. I care about their growth at the company. I care about their growth after they leave the company. That I'm, a mentor and also kind of a longer term industry friend. But to achieve the type of growth that I want for Priority and to achieve the type of growth that I want for them means they're going to have to work really hard. And that like, I'm pretty exacting. And when I need things, I'm not just asking for things willy-nilly. I'm asking for them because there's a strategic reason for them. 9 times out of 10, it's because the clients asked. And 1 time out of 10, it's my prediction powers of they're going to ask this question. So I need this information and I need it now.
So drill down on this for me a little bit, right? Like, what are you high level, you're talking about your leadership strategy, but what does it look like? Are you sitting down every day, every week? Are you going on retreats? Are you, a late night texter? Are you sending 4 a.m. emails? Maybe you're doing all of it, but like, what is like your kind of leadership ethos and the things that you actually do, because you think that it's not going to just help your business, but also help your colleagues and your clients?
Gosh, I try and respect my employees' weekends as much as possible so that they have personal time with kind of their families and their loved ones. We charge pretty hard during the weeks. I wake up pretty early. I'll start my emailings at 5:30 or 6 in the morning. I'll be slacking, deals that I read about that closed, or ideas on who to send, or ideas on which deals to send to like lenders that I just saw something close on, interesting industry articles, and sometimes information requests that'll come in over the night that I need, come in during the night that I need somebody from the team to attend to. And then I'm probably emailing until, 9, 10 at night. Sometimes after that, if I have to, and usually a 12 to 14 hour day is pretty much my norm during the week. Now, not all of that is behind a desk. So much of my business is staying in front of people, doing things like this even. And so like, you won't see me behind the desk all the day, but certainly the rest of my staff is behind their desk most of the day. And they stand at the ready to help. And look, it's just, here's the work. Come spend a few years at Priority. You'll make decent money, maybe even great money in a good year, but you'll meet everyone and you'll actually learn how a deal gets done from a finance perspective on the front end. And building a network for somebody and building a technical know-how and also a qualitative know-how for how a deal gets done, I think can take folks very, very far in their careers. So I think there's a real value proposition there. And look, I want to try to help as many people as I can get there. Mentorship has been always something I've sought, and it's a big part of my life, whether it's Jewish Big Brothers, whether it's partnership forum inside ULI, which I did for a couple years.
I did it as well. It was great. It was great with me.
Right. And so I'm a big believer in that. And look, I view some of the mentoring that I do for our junior staffers as exactly that.
I love it. What are some of the things for junior folks? I was in New York last week meeting with a client of mine, junior guy, and he's like, I listen to your podcast, like kind of wondering, what should I be doing? Like, what would it look like for you? So, talk about a guy who's, 5 years out of law school or out of business school, 5 years out of MBA or out of undergrad. What's your advice to folks who are kind of not just getting started, but like, trying to mature in their career in a real estate business?
Sure. I think once you're 5 years out, you've probably established a foundation. So you have that, and you probably know yourself from a professional perspective a little bit. So you have that too. A kid out of college isn't going to have that. So I think the advice to them would be different. But the advice to that person that's five years in is really like, at that point, I think, know yourself a little bit. Know what your strengths are, because you've identified them over 5 years worth of work. Know what you love to do, because you've identified the things you do like and don't like over 5 years worth of work, and bunker around those things. Find a way, either at your current job or your next one, to lean into the things that you love, to lean into the things that you're good at, to lean into the things that you are passionate about, and find support for your areas of weakness. Do not hide your weaknesses. Our market is too sophisticated, it is too institutional, and it really lives on authenticity. So you will get ferreted out. Embrace them. Say, look, I'm good at this. I'm not good at that. And that's okay. I'm great at the technical, or at the sales part. I'm probably less good at the technical side, though I was never bad. But there are guys who are way better than me. I know that. I have people who are doing that side of it, so I can be out in front of folks. That's really important. I don't have time to sit behind my desk every day and to go through all of our underwritings and our packages with a fine-tooth comb. So I have somebody to do that. But nobody's going to be better than me at sitting in front of a client and then sort of guiding them whether they should pursue a transaction or they shouldn't. So you've had 5 years of experience. Lean into who you are, embrace who you are, and then figure out how to solve the things you aren't great at. I think that'd be my advice to that person.
I love it. I love it. You are exceptionally good at leaning into who you are. And it's such a pleasure to have you. I won't pepper you with more questions. It's such a pleasure to have you on today. Some of my takeaways from this discussion are, number one, deals are getting done.
Yeah.
A lot with the regional banks, which is good news for all of us. Number two is that you got to be a little more creative and a little more nimble. But, whether it's a retail deal outside of Phoenix, or it's a multifamily deal where you put some money in, or even an office deal, deals are getting done. And the last thing is, now's the time to work hard. Now's the time to hustle. Now's the time to be,
100%.
channel your inner Zach Streit and be out there hustling, because it's only going to be good for your career and, frankly, for all of us to get more deals done. So
right.
I really appreciate you taking the time. Thank you. Thank you to our listeners. Thank you to our guest, Zach, today. And appreciate you taking the time.
Have a great show. This was awesome.
Press the lid. The content of this podcast is for the general informational purposes only and does not constitute legal advice. Listening to this podcast does not create an attorney-client relationship between you, the host, guest, or Alan Matkins. You should not act or rely on any information discussed without first consulting a qualified attorney regarding your specific situation. Any opinions expressed are those of the individual speaking and do not necessarily reflect the views of Alan Matkins or its clients.